Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Chris Iggo. He's the Chief Investment Officer of Core Investments at AXAIM. We're going to discuss for the longer term, the recovery trade needs to be built on quality equities. But first, let's go through how we got there as we navigate through the COVID-19 crisis. Chris, thanks so much for joining us and for making the time. And the COVID-19 period of economic distress, increased market volatility, has inevitably drawn comparisons with the 2008-2009 financial crisis. Do you think that's a fair comparison to make?
I think there were some similarities. It's obviously a big economic shock, but there are plenty more differences. And the key difference is what has been the cause of the shock. It's a natural phenomenon. It's not anything man-made. And I think the other defining difference is the speed and the quantum of the policy response.
And do you think this will be a long road to recovery, a more of a phased-in type of approach? I would imagine if you just turn the spigot back on and have the expectation everyone's going to go back to work, all this pent-up demand is just going to result in consumer spend. I think that's a little bit short-sighted.
Yeah, I'd agree with that, Jill. I think, the good thing is that governments and central banks have acted quickly. So they've created a welfare, a social net for the economy, sustaining incomes and also providing a backstop to the credit markets. But it will take time for activity to get back to normal. People will have changed their behavior. It will take them many weeks or months to get used to going out again, going to restaurants, going to sporting events and so on. So I think the fear factor will remain in place, and that will hold back the speed of the recovery. But I think eventually we do get back to kind of normal levels of spending, but that may be towards the end of this year or even 2021.
Now, the Fed is going all in with this recovery. It's acted quicker than it did in the past. It's announced a broader set of credit facilities. Is this the right response, and how could this potentially impact the credit markets?
Yeah, I think it's the right response. I mean, the counterfactual of them not doing that, I think, is not worth thinking about. It would have been a catastrophe for the economy. And again, we've learned lessons from 2008. It was important to make sure that the banking system still functioned properly, that the credit markets were, again, able to open quickly, because back in 2008, the credit crunch really held back the recovery after the initial crisis. So I think it is the right thing to do. It's been encouraging to see a number of companies coming to the credit markets over the last 2 weeks, raising debt, and that will help sustain their businesses going forward. So the credit facilities are really important.
All right, let's review government bonds. Is this still the safest sector to be in? How important is the duration factor to the selection process of an investment and or hedge?
Well, I think, government bonds have played a good role over the last couple of months. They've been negatively correlated with risky assets. So if you did have some government bonds in your portfolio, they would offset to some extent the losses that you took on credit or equity positions. Going forward, it's going to be a bit more challenging because yields are already very low and curves are quite flat. But there is still a little juice left in the long end of the government bond market in treasuries, for example, and in some parts of the European markets. You're not going to make a lot of money by owning government bonds, but it's safe in terms of you'll get your money back. The central banks are buying government bonds, and they will continue to provide a hedge just in case there is a second leg to the equity bear market.
All right, and to wrap up here, is the long-term recovery really about equities, and what kind of equities would you be looking to take advantage of the downturn with?
Well, I think the recovery trade is both in credit and in equities. And, I really like the high yield market. I think with spreads where they are and yields where they are, you're going to get some decent returns from high yield. We had one of the worst months ever in March. That won't be repeated anytime soon. And history tells us that these are very good entry levels for high yield. I think on the equity side, we have to think about how businesses are going to change and how consumers are going to change. There are some interesting long-term trends, I think, that are going to come out of this crisis. For example, digital and technology is going to be a winner given how we've quickly adapted working from home. We're going to see more spending on healthcare. in the major economies, and that will support the pharmaceuticals business as well as the broader healthcare sector. And it will be some time, but I think we will eventually get some kind of recovery in things like transport, travel, tourism, hospitality, and broader consumer services sectors.
All right, Chris, appreciate the insight. Thanks so much for spending time with us.
You're welcome, Jill. Thanks very much.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.